Our oil price is good for the economy. Today, West Texas Intermediate and Brent oil are both trading at about $30 a barrel. And there are a lot of commentators out there who make the claim that the low price of oil acts very much like a tax cut. But the question of the day really, is that the case? Are low oil prices good for the economy? Good morning, my name is Paul Carroll. I'm the CEO and founder of Efficient Wealth Management, a boutique wealth management firm based here in the Woodlands, Texas. One rule of thumb that was recently in The Economist states that 10% drop in the oil price boosts economic growth from 0.1 to 0.5%. Well, in the past 18 months, we've seen a 72% drop in price from $110 all the way down to $30. We certainly haven't seen an associated boost. Why is such a large drop in the price of oil such a great cause of anxiety? Why is it a cause of angst? Well, really there are 6 reasons. I'm going to briefly enumerate them. First, we're looking at collapsing revenues within the industry. And at the nation-state level, this adds to significant instability for some producer countries, that really can't afford it. Gulf states in particular, Venezuela, even Russia is under enormous political instability and pressure due to these lower oil prices. Second, an interesting feature of the American consumer that's changed since the Great Recession is Americans now are more prone to save their windfalls. So not all of those savings are finding their way back into the economy. They're actually being saved or used to pay down debt. Third, the oil producers are cutting spending dramatically. So are the service companies, so are the pipeline companies. There has been an enormous drop-off in demand of high-value production and distribution industries. That's manufacturing, that's jobs out in the rigs. It's been significant. It has resulted in the loss in the United States alone of literally hundreds of thousands of jobs. Fourth, there's a significant debt overhang in many areas of the industry, both nation states and individual producers. And this is causing production to stay at a high level, despite the fact that it makes no economic sense to actually go out and look for more resources. And it's not a profit issue, it's a survivor issue, which is why this will continue until some of these firms, and unfortunately maybe even countries, start to fail. The fifth issue that we're facing is we're seeing risk aversion within wealthy nations spread not just from the oil industry, but throughout the financial markets. We've seen the volatility index spike. We've seen the last 6 weeks of market turbulence. But on the bond side of the fence, we're actually seeing more subtle, but maybe even more significant changes. The pipelines are yielding into the teens, occasionally even the 20% range. High yield debt, even debt that's not related to the energy industry, is starting to pay 6, 7, 8%. As an asset allocator, we're actually excited that maybe in the next 3 or 4 months it will make sense to bring that back into the model when we haven't looked at high yield bonds in many years. Finally, the 6th element that's affecting is low inflation. This fall in the price of energy is putting downward pressure on prices throughout the economy. And already inflation is extraordinarily subdued. Yellen recently increased interest rates at risk to the economy just so there would be the ability to lower those interest rates should inflation turn negative. And a negative inflation is actually devastating for an economy. Japan went through 20 years of deflation. It was very difficult to get out. So there is this danger of deflation if these low oil prices maintain. So that with an oil shock coming in the wake of the recovery from the Great Recession, along with low fundamental yields, low inflation, it is not at all clear that what's happening today is good for the economy. For once, maybe we should all be hoping for higher prices at the gas pump. We wish you the best of investing success.